All right, ladies. Well, I have to tell you, I am so honored to be here today with Ladyboss and all of you. My name is Kayla Goetz, and I have been a financial advisor here at Gate City Investment Services for 8 years. I am a North Dakota bred hometown girl of mine at North Dakota. I'm a wife and a mother to 3 children. So like most of you, busy is a word that comes out of my mouth daily. And so I would just want to take a minute and congratulate you for being here, taking the 2 hours out of your busy schedules and to focus on you and your finance. It is definitely the first step. So today, I'm going to share with you why it's so important to invest, what the process is, what some options you have are, and how to get started. But before we do that, I have to be very honest. Prior to 2009, I knew nothing about investing. I didn't know what the stock market was. I didn't know where Wall Street was. And it's actually a running joke here at Gate City that I asked my boss when I started if Charles Schwab was an advisor in Minot or in Fargo. For those of you who don't know who Charles Schwab was, well, he's still alive. He was an advisor back in the 70s, but he is now the CEO of a multi-billion-dollar company that holds investments for multiple individuals. So like you can see, anybody can learn how to invest. I'm living proof. So let's get started. Why invest? Well, easiest solution to that question, life happens and your finances can change in a millisecond. Let me share with you why I got into the business. Back in 2008, I was so excited because I had just had a little girl. She was my first. I had a great job at a little furniture store in West Fargo named Furniture for Less. Her dad and I just purchased a house. We had a few thousand in the bank. We thought we were doing good. We had good jobs. Sure, we had a little debt, student loans, some credit cards, but we thought we had a good plan. Sadly, 6 months into 2009, he passed away. And my firstborn daughter and I were left by ourselves financially and emotionally. And I gotta tell you, it took a toll on me. It rocked my world. And so I decided that I'm gonna take control of my finances. And I met with a financial advisor. And he taught me the basics and advantages and how to get started. Pretty much the same principles that I'm going to go through with you today and what I teach my clients every day. And when I met with him, that was it for me. I traded in my furniture, selling shoes, and I became a financial advisor. And I've been doing it ever since. Customers here at Gate City and the surrounding communities. So let's get started with the principles that he taught me back in 2009. The advantages of investing. Well, there's 3 of them. Building wealth through compounding growth to help outpace inflation. Advantages. Building wealth through compounding growth to help pace inflation. Well, aren't those long finance terms? I don't want you to worry though. I'm going to go through each one in detail, and hopefully you'll have a better understanding of each one and feel empowered when we're done. So let's start with building wealth. Well, building wealth, I hate to break it to you guys, but it's a marathon. It's not a sprint. Even with investing. Investing is not a get-rich-quick strategy. It takes many years to build wealth through investing? Just ask David Bach's grandmother, Rose Bach. For those of you who don't know David Bach is a world-renowned author of finance. He's written many books. I've read them all. I urge you go out and find one. One of his books, he wrote a story about Rose Bach, his grandmother. Rose Bach, back in the 1950s, she was tired of being poor, and she had to make some life choices, some changes, really. Just like the changes that the girls were talking previous to me, she made a lifestyle change. And instead of going to lunch with the girls Monday through Friday, she decided to bag her lunch. And the money that she saved every week, she decided to go down to the New York Stock Exchange and invest it. She did that consistently over her lifetime to the point where it changed her family tree when it came to finances. So much that her grandson, David Bach, wrote a story about her. Now, how did Rose Bach change her family tree on 50 cents a week? Surely if she put 50 cents a week into a coffee can, she wouldn't be able to change her family tree. Well, you're absolutely right. Rose Bach knew this. And she decided that through investing, she knew there was this power of compounding growth that you could get in the investment world through the stock market. Compounding growth is simply money growing on top of money. It's that simple. Today, though, we're going to play a little game, a little bit of make-believe, and hopefully you can all have a takeaway so you can remember how powerful compounding growth can be. So, everybody, I want you to pretend that you have all won the lottery. You've won the lottery, you've won the lottery, you've won the lottery. I am so excited for you all. Now, you have to choose how much money you've won. Option one is $1 million. $1 million. I'll give it to you today. Okay? So option one is $1 million. Option two is a penny today. That's right. Good old Abraham Lincoln. A penny today. But there's a little catch. I will double the value every day for 30 days. So do you want to choose the $1 million today or the penny today, and I'll double the value every day for 30 days? Take a second, figure out your choice. All right. As you can see, if you chose option two, you would be 5 times richer than the person who chose option one. That is compounding growth. Look at the chart here. You can see the money growing on top of money in the first 10 days. There's not that big of a change. You can see it starting to work on day 20, but boy, does it ramp up in the last 10 days. On day 30, you'd have $5,365,709.12. A millionaire. That is compounding growth. And that is how Rose Bach changed her family tree. Not in 30 days, but in over 3-4 decades, her lifetime. It takes time to build wealth. Now let's transition into inflation. What is inflation? Another crazy finance term. Well, inflation, in simple terms, is the increase of prices on products we use every day. Let me say it again. It is the increase in prices on products we use every day. The only way you can try to build your wealth, to try to outbeat inflation, is through investing in the stock market. Because we've already determined that if you put that 50 cents into a coffee can every week, you're probably not going to change a family tree. So, my favorite example, I do this with my retirees when they retire, because it never fails, never fails. My clients will retire, and the first thing they want to do is go out and buy a brand new vehicle. Typically up here in Minot, it's a Chevy. And I'm partial to Chevys, so we're going to use that as the example. So I always am very excited for my customers. They come in, they drive in, it smells new, it's shiny. They're very excited. It's the present to themselves. They're celebrating their accomplishment. Now, I'm not looking to damper anything, but I do like to help them keep conscious of the money they're spending. So I like to ask a little question. How much was your first vehicle when you started in the workforce? They all chuckle, all of them chuckle, and say, oh, not as much as I spent on this new Chevy, for sure. And I'm like, I asked them, was it $500, $800, $1,000? They all have a number right between there. They know the make and the model, they know the color. Man, they love that first car. And then sadly, I asked them how much a payment was going to be on this brand new vehicle. And guess what? The monthly payment is about as much as they paid for their first vehicle. That's inflation. $1,000 in the 1940s got you a long way than it would today, right? So by investing over a long period of time to build wealth with compounding growth, you might have the ability to beat inflation for the rising costs of the products we use every day. All right, well, we went through the why we should start investing. We went through some advantages, but we still haven't gotten to what is investing. Well, there's a two-part process. Okay, so there's the process and then there's the choices. So first we're going to go through the process and then I'm going to share with you some choices. In my opinion, the process is way more important than your investment choices. So I want everybody to turn up their volume because this is by far the most important part of my section. Before you start choosing investments, you have to figure things out with your finances. You have to organize them. You have to make sure your emergency fund is fully funded. You have to make sure that your cash flow is adequate, that you can start allocating money towards investing. Also, you got to figure out what you're going to invest for. Is it for retirement? Is it for a 20-year wedding anniversary trip? Is it for your kids' college? There are a lot of different goals out there and everybody is different. So first, you have to figure out what your goal is. Next, you got to set a timeline. How long before you're going to need that money? Is it 40 years? Is it 10 years? Is it 7 years? Each timeline is going to be different for each goal. So organize your finances, figure out your cash flow, set a timeline, find your goal. Next, we got to figure out your risk tolerance for the stock market. Investing is like a roller coaster. The stock market has ups and then it has downs and then it has up and then it has downs. It is 100% uncontrollable, unpredictable, and no one can see the future. The only thing that we do know historically is if you do invest in the stock market over a long period of time, you have the ability to gain more money than putting it in a coffee can. So, big roller coasters are for long-term aggressive growth or growth investments. Smaller roller coasters are for more conservative investors. They're going to have small ups and downs. For a visual, think like you're at the Cass County Fair. I like to think of the Ward County Fair, but it's a roller coaster you'd put a 6-year-old up, where the bumps are not as big and volatile as a growth investment. So growth investments, big roller coaster. Conservative investments, small roller coaster. What appetite do you have? All right, so we have figured out the process and we're ready to choose our investments. There are thousands of different things you can do. Today, though, we're going to focus on the top 4 you probably hear every day and that are typically used in 401ks in personal investments. So let's start with, in my opinion, some of the riskiest ones. Stocks. Stocks are simply ownership of a company. So if you decide you want to get on the big roller coaster and purchase a stock, you're just basically saying, here's my money, and I'd like to be a part of your company. Now, when that company has profits in a year, they might give you a percentage of those profits back through a form of a dividend. Another way you can make money by owning a stock is if the stock price goes up. If you purchase a stock at $50 and the company becomes very popular and lots of people want to buy that stock, well, through supply and demand, your stock price will go up. So if your stock price goes up to $100 and you decide to sell it, well, you just made yourself a $50 profit. However, you are putting all your money into one company. So be mindful of a company that you choose, because if that company goes under, bye-bye goes your money. Now, let's switch roles and go into a more conservative investment that is complete opposite to stocks, bonds. Now, if you purchase a bond from the federal government or a company, you are not saying you're becoming an owner like a stock. You are simply saying that you want to borrow your money to the federal government or to that company for them to use to improve their company or build a school or build a new building. And that company decides that they're going to pay you an interest rate on your money for a period of time until they're done using it. When they're done using the money, they give it back to you. So bonds are considerably less riskier than stocks. Okay, now we got those 2 in the middle, mutual funds and exchange traded funds or ETFs. Wow, okay. Diversification. Let's talk a little bit about that, because that's the reason mutual funds and ETFs were created. So back in the day, there was only stocks and bonds. That's all you could get. You could go down and buy a stock at the New York Stock Exchange, or you could get a government bond from a federal government and help them fund a war. But that can get very expensive quite quickly. And you're not diversified. If you had one company stock and one bond, well, if the company goes under and the bond defaults, you lose all your money. You want to own lots of different companies and own lots of different bonds. And the only way to do that is through a mutual fund or an ETF. So they're both constructed pretty much the same way. When you have a mutual fund or an ETF, I want you to imagine an umbrella. And you're purchasing the umbrella. But underneath that umbrella, there is hundreds to thousands of different companies. So you may purchase one umbrella, but you have exposure to many different companies under there. Diversification, spreading your money out to lessen the risk of your investing. That's why mutual funds and ETFs were created. Now, there is one distinct difference between a mutual fund and an ETF. Mutual funds are traded at the end of the day, and ETFs are traded throughout the day. It's the only difference. ETFs are traded during the day, and mutual funds are traded at the end of the day. Okay, so we have gone through why we should invest, advantages of investing, what the process is. I gave you some options. Now the most important question, how do I get started? Well, there's really only two choices. You can do it yourself, or you can hire a licensed financial advisor. I'm going to walk through both of them with you. Do it yourself, we'll start with. If you're going to do it yourself, there are many fabulous platforms like Acorn, Robinhood, E-Trade that are designed to help a user purchase and sell investments in real time. It's very convenient. It's also quite cost effective, and you can do it on your phone. One of the things that these platforms will not do for you, though, is they will not do the research for you. They also won't help you buy and sell. When's the right time to buy? When's the right time to sell? They also don't know your full financial makeup. And so if you're going to go do it yourself, make sure you have the time to do the research and the stomach for the market volatility of the ups and downs of that roller coaster. Okay, let's transition to licensed financial advisor. Licensed financial advisors are licensed in investments. They can do the research for you. And typically, they know your whole makeup, all your finances, what your goals are, what season of life you're in. They care. I like to say the main purpose of a licensed financial advisor is to help you remain confident in your finances. Because like I said, life happens, and our jobs are to help you regain confidence when you lose it in different seasons of your life. Now it's total perfect personal preference if you do it yourself or if you hire a licensed financial advisor. But that's not the biggest takeaway of this session. The biggest takeaway of this session is to just get started. Be consistent and have patience. Now, in the next slide, I have a few of my favorite resources, books, podcasts, and information for you to consume. Take the time. You've already taken the first step. You're here. So make sure you plan out in your calendar to dive a little bit deeper in what investing is and the little tips and tricks you can learn along the way. And if you ever get stuck, I'm only a phone call away, and I am happy to help you in any way I can. Okay, now it's time for questions. So what kind of questions do you have?
The book that you mentioned right at the beginning, what was the name of the book from David?
The Latte Factor. He's written many books. So on The Latte Factor, he touches on his grandma a little. I haven't had the privilege of reading his most recent book, but if you Google his most recent book, it is all about his grandma. And I haven't had the privilege to sit down and read it myself, but David Bach is definitely one of my favorite resources.
Question that came in, what sort of investments do you recommend for people in their 20s? S&P, or should we find specific companies we want to invest in?
Well, it all determines on how much time you have and how savvy you are in the research that you want to do. So let's look at the timeline. You're in your 20s. First, what are you investing for? Are you investing for retirement? Because if you're investing for retirement, historically, you have all the time you need to be as aggressive as you want in the investments that you choose. But if you don't know what companies you want to invest in and you're looking for just how to grow your money over a long period of time, I would really urge you to look at the diversification of mutual funds, because then you'll be able to have multiple different companies in your portfolio and someone will be there to help you manage it, because that's what the mutual fund companies do.